But the government does allow you some benefits, and that's what I want to talk about next. So you guys take a look now. If you see foreign earned income exclusion, and this is the big benefit that many taxpayers can get if they do qualify. Okay, and what the foreign earned income exclusion does is it allows taxpayers, U.S. citizens living abroad, to exclude for 2012 about $95,000 of their earned income. So this one is a very good benefit for those of you who are living abroad, have a foreign job, and you can exclude your earned income up to this amount. And the other thing is you can also exclude foreign housing exclusion. And for Hong Kong, which is one of the most expensive cities around the world to live in, based on US government statistics, you actually can exclude up to $114,000 of foreign housing allowance. That's also a good benefit for US citizens. But the one thing is you need to make sure you qualify for these exclusions. And there are two tests called the Bona fide residence test and the physical presence test. So you need to qualify for either one of the two tests in order to meet the requirements. So first of all, let's get some water. And for the bona fide residence test, what it says is that you need to have established your residency in a foreign country and made a good faith effort to show that you've been you've accepted your new place of residency and you have no direct intention of moving back. And those ways you can show are maybe getting a Hong Kong ID, paying Hong Kong taxes, opening a Hong Kong bank account, or maybe for people who have kids is sending their kids to school there, and renting an apartment. So those are some ways to show that you've established a bona fide residence in a foreign country. Very important. But the one catch with that one is that you would need to have stayed in a foreign country for over one full calendar year, from January 1st through December 31st, to qualify for the bona fide residence test exclusion. The other one is the physical presence test. And this one is a little more tricky, and you just would have needed to stay in a foreign country for more than 330 out of 365 days. And this does not need to be in a calendar year. I'm not sure. Are you familiar with this test, David?
Yeah, I passed it like 6 years ago.
Okay. Okay. So, quite important.
I'd like to have 35 days of vacation actually in the US, to be honest with you.
But, okay, actually a good point, because there are many times when actually a few taxpayers I know have actually been disallowed this earned income exclusion or the housing allowance because they cut their time too short. So what happens is that, I'm actually going to show you and read to you an excerpt from the IRS, is that traveling time does not count. Okay. This is actually from one of the IRS publications I want to share with you guys. Okay. So when you leave the United States to go directly to a foreign country, or when you return directly to the United States from a foreign country, the time you spend on or over international waters does not count toward the 330-day total. And additionally, an example would be if you leave the United States for Hong Kong, say by air, on June 10th. You arrive in Hong Kong on 9 a.m. on June 11th. The actual first day that you qualify for the physical presence test is on June 12th. So you leave on June 9th, you're traveling, you get to Hong Kong at 9 a.m. June 11th. You actually can, first full day is on the 12th. So something to be aware of. Yeah, and so I actually, like I mentioned, I knew a taxpayer who thought that he could go to enjoy his 35. He kind of thought he was reading up, he knew the regulations, knew the tax law. Said, I'll take my 35 days in back in California, in LA. Then when he came to me, he actually had to show all of his passport dates, his actual travel itinerary, to prove and identify when were these exact days, because you need some kind of evidence to prove this time that you were traveling, whether you're in Hong Kong or US. And when he actually did look at it, and we looked at the situation, he unfortunately didn't qualify for the exclusion, and he was taxable on his earned income that he made for that year. And it's very unfortunate because he thought he understood what the requirements were. And so it can be something that's very important to be aware of when planning your vacations abroad if you're going to qualify for the physical presence test. Be careful about. And the other benefit other benefit is foreign tax credit. Have you heard about that before? Yeah, I know you did a little bit of research.
Yeah.
Okay. So foreign tax credit basically is a dollar for dollar deduction for foreign taxes you pay. You pay Hong Kong taxes, you can get a credit for Hong Kong taxes you pay. Benefit is it's dollar for dollar. One thing that you need to be aware of is that you cannot take the foreign tax credit if you already excluded that income. Okay. So say for example, you make, let's say for 2012, taxpayer makes $110,000. Or, okay, and they are, let's say $105,000, make it a little easier, 105,000 US dollars. They take the foreign earned income exclusion, so they can exclude $95,000 of their income. So taxable income is actually 10,000 US dollars. They can only get a credit for the amount of Hong Kong taxes they paid on that 10,000, not on the $105,000, because you already got a benefit. You already excluded that income from tax, so you don't get a double benefit for taxes or once you exclude it. Any questions about this part?
One question.
Yes, sure.
About because I'm not a US citizen, I'm not quite sure about the tax rate.
Yes.
What's the tax rate for people living in foreign countries?
For US citizens?
Yes.
Okay. US citizens living in foreign countries for 2000 and, okay, for US has a marginal tax rate. So if you make less than so much money, say you're taxed at 15%. If you make more than that, you tax 20%. And the highest tax rate for 2012 is 35%. But in 2013, the highest tax rate just went up to 39.5%. So it's 40%, say 40% tax rate. And you still have to pay maybe state taxes, you have to pay maybe self-employment taxes, maybe social security taxes. So there's a lot of other taxes that need to be applicable as well. So as you realize, maybe tax rates are very extremely high. You make more money than that. The next thing, just very briefly, talk about some income sources. You see this, we have some wages, interest, dividends, capital gains, and owning your own business, and rental income. These are some general sources of income. So, yeah, I'm not sure how many of you guys talk to you guys too, but you guys probably are more familiar with Hong Kong tax system, where you're only taxed on, say, your maybe salaries, or maybe you have a business, taxed on that. But in the US, they have all these additional taxes. You buy and sell stock, you pay some taxes. You get dividends from a company, you have to pay taxes. You have rental income, you have to pay taxes. So it is a significant burden on many taxpayers. And one difference though in Hong Kong. Okay, now I actually want to talk briefly about some Hong Kong taxes. Just want to touch base briefly about that. Hong Kong taxes, the one thing that many US taxpayers don't realize is that Hong Kong uses, I guess you could say, a fiscal year, April 1st to March 31st.
Sorry?
For Hong Kong, fiscal year from, let's say, April 1st,
Oh.
March 31st. US always, for most in, I shouldn't say, a big majority of US taxpayers always use a calendar.